Good evening. Ira Epstein of Linn Associates with your financial market wrap-up for this Wednesday, October 7th, 2020, 6:35 p.m. Central Time. Interesting. You know, the president comes out with his statement yesterday, rattles the market by saying no more negotiations on the COVID-19 bill. That lasted about 6 hours once the stock market fell. He then came out and said, no, maybe we should do piecemeals for the airlines and small businesses. The response from Ms. Pelosi wasn't a flat no. So the market liked what it heard, and today you were up rather sharply. I mean, this is what we have to live with. It's in that period of time now, we're just over 3 weeks away from the election. It's going to be volatile. You can count on that. Extremely volatile. Energies were lower most of the day today. Bonds and notes just sort of hanging here. I think we're all looking to see how the Biden-Harris debate goes for the vice presidency tonight. That should be very interesting. Metal markets, well, just sort of drifting. Copper was the stellar performer. You know, copper this week, just 2 days ago, was 284 or so. And now it's back up to 303. I mean, it's Golden Week in China. You don't get their trade, and you need their trade to stop the thinness of the market. And the market just moving out of motion all over the place. But let's take a look at the S&P. For the week, you're up 2.2% roughly, up 73 handles. That's pretty darn good. And the market's over this number that you had back here that I'm pointing to. If it can stay like that, it's a signal that this part of the break has at least gone into a pause, and you might be back into the uptrend again. That's how it's looking. As you take a look at this chart, I've pointed out that are we going to get an inverted head and shoulder? A head, a shoulder, another shoulder. Then you flip this over and you turn it around the 3650. If that happened, would be the objective. We'll find out. We're approaching that point. So you're fighting right at that what I'll call that neckline. As we take a look at the swing lines, when we put these on, the chart looks different right away. You can see how you look here. All I did is add the swing line study, and it looks different. I want it to look different. I'm looking for the pattern. Is it bullish or bearish? It's bullish. When we define a bull trend, we're looking for higher highs, higher lows. You certainly have that right through here. Then I look to see where's the support. I put on moving averages. My line in the sand is the 18-day average of closes. The market has played at it, and it's trying to move away from it now, making the higher highs, higher lows. If we take out the highs of today, and tonight we haven't done it yet. We have to see if we can get over that. If you do, then what happens is this becomes the new swing line low, and a very important number not to take out. So the lows today, and this is how we were today. Remember, I'm in the evening trade, was 33.32 and a quarter. Got down, hit the 18-day average, and turned itself around from there with a big run. Just what we were expecting. If you get my morning subscriber video, I was pointing all this out to you. The risk on the trade was not small. If you bought it there, your risk was all the way back to 3,300. So it's a 30-point risk. That's not a little bit if you're trading full-size contracts. If you're trading the micro mini, it was $150. Not bad. So those small contracts come in very handy. Now where's the resistance? The upper Bollinger Band, 34.43, let's call it. So if you can get there, that's where I expect some of the pros to take money off the table as you're getting into overbought territory. That doesn't mean you can't go higher, but that's where you start grabbing the money so that you have buying power if you need it on pullbacks in the market, or if you want to take some cash off the table and just see what goes on. So bullish, overbought, seeing if we can get up to that other number. There's something else that you're looking at in this. I want to see if it happened here. Not yet. You had an outside day down. Do you see that right here? If you take that up, while it's only the Bollinger Band I'm looking for, it would spring a trap on all these bears. I'm getting some interesting work that is bullish. In the Nasdaq, overbought, swing line down, lower highs, lower lows, right into, again, that 18-day average of closes, my line in the sand. That's where the market tries to figure out what it's going to do. The contra trend traders, they made their money there. Why is this contra trend? the swing line's down, so that is a trend, right? But it's also over the 18-day average, so the bias knocks it out. So which way do you go with it? I don't know. When bias and the swing line don't go together, I don't do anything. There's the filter saying do nothing. Now, I want to take you back 2 days. Here is the Dow, and the high on this day that the president pulled his quickie on us was right here, 28,232. If you take out that high, you spring what I call, my definition, if you do it within 2 trading sessions, a bear trap. You did it today, which often results in prices making a run to the closest moving average above the market or the Bollinger Band. It's typically one of the two. All the key moving averages are under the market, so it's the Bollinger Band. You're overbought. That could be where you're going. In order to negate this rule, you got to get back through the lows of Tuesday. And this is Thursday's trade you're already looking at. In the Russell, the market is still the strongest of the indices. It keeps running to the upper Bollinger Band. You're not seeing that on the others. The trend is up, higher lows, higher highs. It is overbought. Could it embed? Well, not until you're into Monday. That would be the earliest it can do it would be Monday. So it's just overbought at this point in time. But when you get these small caps jumping, traders pay attention. And they pay attention because that tells you that these smaller businesses are coming alive. And if they're coming alive in terms of investors wanting into them, and that's why you're going higher, maybe there's something big going on in the economy. We know there's been a rotation with the tech stocks into other areas. This is certainly one of them. In the VIX, you keep hitting the upper Bollinger Band and falling back. But with these big rallies, you still haven't taken the VIX out of an uptrend. You still have higher lows, higher highs. You hit the upper objectives. You keep pulling back. Momentum is flat. It hasn't turned down. This market is still bullish. So you have a bull run in stocks and you got a bull run in the VIX. Are people buying a lot more protection as this market's going higher? Certainly appears that way. In the T-bond market, how many days do we now have? 3 days in a row of settlements underneath the lower Bollinger Band. You're oversold. The odds of staying under that band for tomorrow, which is Thursday's trade already, are 2%. Why? 5% of the time the market will stay outside of a band, be it the lower band or an upper band. My rule of thumb, and that's all it is I count each consecutive one and take away one of those percentage points. And yes, in theory, you can get to 6, and that means you're in a -1. But do your work. You will see what I'm saying. The idea of Bollinger Bands is where to come out, not where to reverse and be long. It's maybe the market's overdone and it's going to get back within the band. It's going to trade in that band 95% of the time. So if you get deep enough outside of it, traders use that as a way to take some money off the table. Same thing in the 10-year note, 3 days under it. I say it's going to try to get back to the right-hand side. So these big spikes down offer the traders that are short, because that's been the trend, an opportunity to maybe take something off. In the dollar index, you are sort of in the middle of a downtrend by just the skin of its teeth. How? Lower highs, lower lows. Tonight a settlement underneath the 18-day average and momentum down. This whole thing blows up if you get over 94.09, and it gets reaffirmed if you get under 93.37, opening the potential doorway for the lower Bollinger Band. Very interesting number. Now, what is it? 5 days we're churning at that number. It's the flip-flop in the euro. You're churning right against the 18-day average to the upside. This market's in an uptrend. Settlement over the 18-day average, the bias not pointing down, still slightly up, and you have the swing line up. So I'd say the pros are buying this market. Stops will be under that low. They're hoping to get a pop maybe back to that 118.90 area. In the end, the market, when it's dropping like this, is telling you they don't want this safe haven currency. And that's what you've done. You've put yourself now back into a downtrend. Now, if we come back to yesterday, you didn't have that. But if you took this number out, you get it. Unfortunately, you're already oversold, and that's just what happened. So I'm looking at big support right in here, oversold, hard to get short a market that's already dropped this much. In Bitcoin, the battlegrounds, the 18-day average of closes, it's watching gold. You can just see it. It's got a similar gold pattern. It's really caught at the 18-day average. The trend is down. The bias, you can see the trend is down. The bias is flat. And, well, actually, the momentum is flat. The bias is still down. If you take out this 10,940, you catch this market, it might go to your upper Bollinger Band, you catch those that are short. But right now the shorts have control of the market. The differential between Brent and WTI crude, well, it made a new low the other day, as you can see right here. It got down to 172. That's the lowest it's been in it might be a year. It's quite a period of time. It's trying to get a little rally. It should encounter a lot of resistance, anything near this $2 level. It's 197 there, as it's been running into it and getting problems. So does that mean Brent's a little bit stronger than the WTI for the moment? But when you come to the chart, you're really not doing much. You got a higher high, lower low. The 100-day average of closes has turned into its main resistance point, keeps falling back to that 18 without a trend. So you're just going like this, probably pulling your hair out because it's not trending one way or the other. And the same darn thing is true of the November WTI crude. They're both doing the same thing. You got to be patient with it. As for gasoline, you've gone from the 100-day average to the upper Bollinger Band, sinking back today, overbought and not in a trend. Leave it be. Natural gas, you got to be careful of wanting to be short just yet. Why? Because you got a hurricane, Delta I think it's called. It's headed right into it's in the Gulf. It's headed towards Louisiana, maybe Mississippi. They closed down again the oil rigs, the gas rigs. You know, you've got to take your people out of harm's way. How many storms like this have they had? It's unbelievable. If it hits New Orleans, this will be the test as to whether or not the Army Corps of Engineers did their job and those floodgates and everything, protect the parishes. We'll see. I don't want it to hit it to find out. Not interested in that experiment, but it's headed there as a Hurricane 2 or 3. We'll see what the track finally takes it to be. You know, a tool that I use in markets like this, because sometimes they offer opportunities to talk to my subscribers, tell them where a market's getting overdone or oversold sometimes, are pivot points. They're just for the day. You don't carry a pivot point over from day to day because you get a new formula each and every day that determines it. But here's what it does. Most people use these pivot points on 5-minute, 15-minute charts. They're not using it on day charts. And what you're looking for is the pivot. I made a 3-part video series. Part of each one is a PowerPoint. For example, I teach you the formula. Then in another video, and how it works, then I show you how to plot this on your chart, the colors I like to use, and then my interpretation of it in the third part. And it's all free to you. But you're looking for a market that gets up to the resistance. They'll call these resistance 1, resistance 2, support 1, support 2. This is exceptionally popular in FX trading. I mean, really popular. When I talk to FX traders, they're using this, and they'll use more than 2 of these numbers. Those traders sometimes go out to 4 of these different, and it's simple to adjust your formula. But instead of just using it that way, I tie it together with momentum, which I don't see most people doing. And in the momentum, I like my slow stochastic study because I'm looking for where it peaks and bottoms out so that momentum is changing and I get an opportunity if I want to take it, or it's saying, hey, I've peaked out but I'm not breaking. That's a warning sign if you're short that something else is going on because you're not getting a break with the market. As I said, it's for the in and out trader. This is pretty cool tool if you're trading those micro mini stock indices and so on. Very much fun. Inexpensive, $1 a trade per side with us. It's not expensive to trade at all. And then you get to the point where lower exchange fees and all are part of that too. You then get to the last part, you're taking 1/10 the risk. So it's pretty interesting to do with all that. But if you'd like to learn more about this, it's on our website under our free offerings. Just go to www.iraepstein.com. You'll see the free offerings. Take advantage. We'll get it to you. We'll send you a link that's all there. I'm Ira. You have a great day, and I'll talk to you tomorrow.